First of all, I mean, I'm going to be speaking English. I know this is an Arabic conference, but my sincere apologies. First of all, I would like to take this opportunity to sincerely thank the organizers. Iman, Rami, you guys have been great in approaching and reaching out on LinkedIn to a few people that have at least enthusiasts about blockchain like myself. I was able to connect you with two individuals out of Palestine, one from the West Bank, the other from Gaza, a researcher and also a technologist, right? But I am just an enthusiast about blockchain, and I'm very delighted to see that someone in the region is taking, is taking blockchain technology into new dimensions across the region. And as I said, happy to continue dialogue with everyone and anyone that would like to support Palestine in the blockchain technology. Myself, my name is Laith Kassis. I've been supporting tech entrepreneurship and startups in Palestine since 2004. I am now working with Fikra, which is a Paltel Group Innovation Hub. Paltel Group is our biggest economic group in Palestine. It's a telco group. And the Fikra Innovation Hub is part of this. It's like a corporate entrepreneurship program whereby we support entrepreneurs with a co-working space. We have a community of founders and startups. We launch events and do events like hackathons. And we do mentoring and coaching to startups. And we do invest in startups. Our average investment ticket is around $200,000. And the other thing that we would like to help Palestinian startups with is called smart sourcing. Basically, we bridge the gap between them and our four main companies. If they find value in one of the services or products that startups are selling, then we would like one of our companies to like pilot and test these products and purchase them. So that's in a nutshell what Fikra is all about. Today I'm going to speak about a topic that has to do with enlightening us all about what is this thing about technology entrepreneurship financing. I'm not going to go over budgets or number crunching. My presentation will be all about the basics, about what is technology entrepreneurship all about, what is technology financing all about, and how to increase the value of any startup. And this is what the focus will be on. So without further ado, thank you again, organizers, for this opportunity. I have shared my slides, and I will go full screen, and exactly this is what today's discussion will be all about. So, but prior to that, I think it's only wise that we will go over the four phases of what technology entrepreneurs and technology startups go through. If you haven't seen this graphic before, it is called an S curve. Sometimes it's called the J curve. But you'll notice that two colors associated with it. One in red and the other is in green. Basically, the red is when you're losing money, you're still not making any in terms of profits. Your cash flow is in the red, right? And once you hit the break-even point, that color starts changing to green, meaning you're becoming profitable. So it is called an S curve. Sometimes it's called the J curve, especially when the letter J resembles that. So this is like a curve that represents a high growth business model for a tech startup, right? This is how it would look like. If it's not a high growth, and if you have like fixed income, you would tend to see the green line as being flat one. So you're making money, but it's a fixed, more or less almost the same month on month, year on year. But in a high growth startup, you would have this steep curve, a J curve in terms of growth, in terms of your cash flow and in terms of revenue. And this is, I think, one of the key differences between a tech startup and any type of a startup or any type of an SME. All right, so let's go over the 4 phases. I think the first one, we call that pure entrepreneurship. And what does that mean? You know, we at accelerators or incubators, we are in the business of helping founders to define their concept of business. You know, one of the things that differentiates startups and entrepreneurs from business people or businessmen or businesswomen or any corporate is that you normally tend not to have any resources, right? You just have an idea. And that basically what characterizes a founder. So, but the key skill for any founder is their ability in getting resources that they normally don't have. And there are 3 main resources that we can think of. The first is the people. Second is money and funds. And the third has to do with technology, right? So those are the three main things that people should be always perpetually fundraising or trying to seek in terms of resources. So in the first phase, you're trying to seek out those resources and you try to assemble them and you're trying to build your prototype and you're also trying to get your first customer. And each one of those things, there's a science behind how to do them, but it's also a combination of an art. Seasoned entrepreneurs are much more experienced how to do it. This is why seasoned entrepreneurs have, you know, they attract investors better than novice ones, right? But this is the first phase of pure entrepreneurship. The second one, we call it strategic focus, right? We are still in the red, we're still losing money, we're not making any, right? But in this phase, strategic focus is exactly that. It's focus on what business you're in. It is as important to know what business you are not in. We've seen startups or we've seen founders continue to be sales driven. Any sales opportunity that comes their way, they're happy to take it and do it. But this is not the good practice. The best practice is you deciding as an entrepreneur, what is it that you want to do? And then accordingly, you as an entrepreneur would have to know better than anyone else, what is it that people want, whether they are willing to pay for it, and whether they're willing to buy, and whether people are willing to entertain the product that you're shipping, right? So it is going beyond developing a prototype like in the first stage. Now there's more interaction with the market. And here we have to understand what the market needs and what the market wants more than anyone else, and develop a niche in our business model accordingly. So that's the second phase. Now going to the third one, it's system building. And this is what is very confusing really, because the dynamics of any startup in the first 2 phases are different than the third one, because in the third one, we are now transforming into a corporate structure. In the early days, any startup would have a very informal setup, should have a very informal setup. Sometimes it puzzles me when startups or founders they put themselves as CEOs, they like the titles, and they start dealing with the startup from a formal point of view. Send me this email. You haven't talked to this. I want you to request a meeting for us to do something, right? It should not be a formal setup. The first 2 stages should be informal, very informal. The team is flat. There's a team dynamics. This is the way that any startup should begin. But once these sales start, you know, being generated and you start having high growth, this is the time where you start to transform into a corporate. And this can be puzzling to any founder, because founders and CEOs have to also transform accordingly. They need to start understanding the nature of the corporate, and they need to understand the nature of formalizing the business, formalizing the way sales is being done. In the early days, you would evangelize your product, you would evangelize your idea, you talk about them day and night. and you need to convince early adopters of taking the risk in trying them out. But once people know more and more of your product, then the sales cycle have to be formalized more, and the sales team have to be structured accordingly. See, so that like can be puzzling to certain founders, and it can be transformative to many individuals that they need to act on a formal corporate merit and corporate basis. But this is what the third phase is all about. It's about systems building. It's about transforming to a corporate structure. The last one is like, now we're corporate and we manage everything from a corporate point of view. Perhaps an example in all of this can be, like benchmarking Silicon Valley companies. If you take Google as an example, it started out with two founders out of Stanford University. In 5 to 10 years' time, they transformed to becoming a multinational and a corporate structure, right? So the timeline for these four phases and for these transformation to take place can be as fast as 5 years, right? In the MENA region, because we are not Silicon Valley, they tend to take longer, but more or less these are like the processes and the steps that any startup would go through. Right. So this is an S-curve. Sometimes, we have a question here. Should there be another S-curve for the venture? I'm not sure whether anyone from the participant would like to have a take on this. What do you guys think? I'm happy to answer it myself, but if there's anyone willing to raise hand and share with us their point of view, that would be nice. Rami, I can't see people if they raise hands at my end, but if there's anyone, I invite them to jump in and share with us their views, if they like.
Yeah, everyone can raise hand and
okay.
Voice.
Right.
Yeah.
So again, we have one S-curve for any startup, but what do you guys think? Would there be more S-curves for any venture? The answer in short is yes. Yeah, because once you reach this here, this is called the mountaintop. By the way, the whole red thing can be called sometimes valley of death, because rarely anyone, like the success, the failure rate of startups is like 95%, right? So this is like called the valley of death, this red zone. But once you are on mountaintop, right? Sometimes you have a life cycle for any venture or any product, right? So in the life cycle, you reach the top, but you tend to have also a decline. And what happens after a decline is, of course, your revenues start diminishing and decreasing. So what do tech startups normally do? They are again in perpetual mode of innovation. So they have to create another S-curve, but they don't necessarily now have to start it from a red cash flow. They would probably start it from the mountaintop, but they have to introduce new product line items. They have to introduce a new innovative business model, which may not have immediately this high growth revenue stream, right? But these new S-curves is one way of perpetuating the venture sustainability and longevity, right? So yes, we are in the business of a continuous innovation. It is not one shot in terms of launching one product, one revenue stream. On the contrary, any startup will have to continue innovating as they go. So that's basically, in a nutshell, the four phases of any tech startup. And now, what financing? How does financing work for a tech startup? And this is what the next section is all about, right? One key thing we need to understand is that value for any startup is a step function. It does not happen as a big bang. You cannot. Sometimes even in our own personal careers, we want to skip the whole ladder. We want to be on top of the moon from day one. I've seen graduates from university from day one, they want to become CEOs, managers, this and that. Unfortunately, the more experience and the more grit you develop in your career life, the more qualified you can become as a professional, and this is how you accumulate the experience. Likewise, a startup has to accumulate value over time, and value is a step function in three main areas. The first one is technology. So you do increase the value of your startup in terms of financing by improving your technology. And this is, and what differentiates a founding team from the second or the third is that their ability of transforming their ideas into valuable technologies, right? Those that are able to do it, they will garner higher valuation when they are in negotiations with investors. And they need to be able to demonstrate key milestones from the day of inception and conceptualization of the idea, all the way when they take this to the market, and all the way when they go to the market and introduce this new technology, right? So it is a step function over time, and this is how value is, it gets higher for any startup. So that's the first pillar, technology. The second one, it has to do with the people. I always say technology is a people industry. People do make the difference in the technology business. Startups is no exception. If we like say the founders of Careem, if they want to do another startup, you'll find investors willing to invest in them much faster than any novice or any founder or a startup that did not have an exit, or they were not able to demonstrate how they are capable of increasing the value. So people behind startups, in terms of their experiences and whether they are part of the team or not, does make a difference. And the right people with the right experience do bring value to any startup into a management team, right? So that's the second pillar, has to do with people. The third, and this is like the most critical, is the market traction. Again, it's a value that increases as a step function over time. Hardly anyone can say, I'm gonna say, this is like, we tend to hear this a lot from entrepreneurs. So what is your market? And the immediate response most of the time is that I'm gonna sell to anyone and everyone. But but it doesn't work this way. Selling and market penetration for a startup has its own science, right? And here people probably we need to read books like Closing the Chasm by Jeffrey Moore, and we gotta be understanding the good practices behind it, because it has to do with segmentation. There are certain strategies in marketing called beachheads, bowling alley, and the like, which enable any founder to qualify segmentation in the market, introduce the new technology to it, and then transition from one segment to the other accordingly. So again, a step function. If you're generating sales, if you're capturing and acquiring market share, then by all means, you're increasing value for your startup. In other words, anyone that comes forth to an investor with just an idea, from a market value point of view, it will carry less value. Anyone that comes forth to an investor that proved the concept for the product, have been generating monthly recurring revenue of say 30,000, then they've proven that there is a market out there that is willing to purchase this product and willing also to buy this product, correct? So this is one element of increasing the value for your startup, is by developing market value. And the final thing I would like to say about market value, it reminds me when we sit as judging panels and founders and startups and entrepreneurs in front of us pitching their ideas to us, right? And sometimes, you tend to notice like Shark Tank or like judging panels members, they start like prophesizing that whether they like this idea or don't like this idea, whether they think with their own biases that this idea will work, but that idea will not work, etc. But in my book, I sometimes refrain from passing out judgments on ideas, because the ultimate judge on any idea is really the market, is the people, whether they're going to buy this or not, right? So the hypotheses in the early days that this new innovation is going to sell or not, only through entrepreneurship process and through entrepreneurship phases, that entrepreneurs can launch this into the market. And if they can and are able to develop market traction, then this is the ultimate judge whether this is going to pass or not. I think I'm running out of time, but this is how new ventures, right? This is how the new ventures, and this is how we're growing the value of our startups through this mechanism. So again, value is a step function. Worry about producing the best technology, whether it's in blockchain or any other emerging technology, right? So make sure you have a very sound, solid differentiation factor for the product you're working on. Get the best team around you. Do not shy of having A people to be associated with your venture. On the contrary, it's a must. The third is really look for the markets and have a good strategy to do markets, okay? So I think with time constraints, perhaps, Rami, we will stop here, right? And if there's any question, what do you think? Give me your 2 cents on it.
Yeah, I believe we do have like 5 minutes. If
Okay.
there are questions, let them jump and connect and speak directly. You carry on until someone stop you in a question.
Okay. All right. So the third and final section, I'm time constrained, is that I wanted to take you through an expanding value pie. So in the first instance, if 3 founders come together and they distribute shares amongst themselves, each 1 million share, just an idea stage with this price tag of a share. So let's say we have a post-money valuation of 3,000, okay? Well, once they start adding a president that is seasoned and is a great manager and he has previous exit experiences, you'll notice that post-money valuation for this company increases, right? But I want you, and there's a concept that I wanted to show, is like there's something called pre-money and post-money. Post-money is basically when we add whatever investment amount comes to the company and we add it to pre-money valuation. So now we add a president. Now in this next step, we add what is called employee stock option plan, right? So total shares is 5 million and post-money valuation is 50, right? Just notice that each of these founders, when they started, they had equity share 33.3. They divided this in equal to each one of them, right? You notice that the percentage decreases over time, but the value of their shares increases over time, because the value of the company, the pie, this is why expanding the pie keeps increasing over time. So what normally happens after that is another investor comes in and the price per share increases, and you will notice that again the percentage of their equity decreases, but the value of the shares continue increasing, and the post-money valuation continues to increase. And every time there's something new that takes place. We've proven a step function, a key step function. We've proven that the product is selling. We have a great team, and we've proven that the product, we've protected intellectual property of it. So we're increasing value over time. This is the game that people need to be associated with. And then another investor comes in, and this is what is called Series B. And these guys also have to take us to a new growth area, right? So you are in a perpetual mode of fundraising as an entrepreneur, no doubt. because every time you need to target new markets, every time you need to improve the product, increase its functionalities, every time you have to increase your workforce and bring in more talent, and more funds will be required to be able to do so. And the trick is, through the three key functions, is that your job as an entrepreneur is to increase the value of your startup accordingly, because you want, every time you close a financing round, you have to worry about the post-money valuation. If you're going to continue worrying about your percentage, how much percentage of your stock you own in the company, this is not the game that is being addressed in a tech startup financing, as much as increasing the value of your shares as you go forward through attracting funding and through closing higher post-valuation, post-money valuation, all the way to making an exit, right? And these are very quickly some of the things you have to watch out for in terms of creating value. We've discussed most of those as well. I think we'll stop here. And if you know of any exit strategies that any startup would look for, happy to hear them. If there's any questions that you have, I'm happy to also address them.
Thank you so much, Mr. Laith. Really great and informative information. We can expect like less than a minute questions. If you have anything, voice or chat, feel free to reach out to Mr. Laith through the platform. He's the very expert person, I believe, in this domain. And as an initiative also from our conference that we are hosting Palestinian speakers, initiatives, all of these to support the people. Really, we are happy. Everyone can engage with them. Check what you can support them. We are not talking about money. We are talking about business.
Yes.
They are calibers. They have startups. They have skills. I believe we compete across all of the world. And even if you need the co-founders, you need let's say a
development team. If you need, you
consultant, translator, anyone. Just reach out to Laith, to anyone from our Palestinian speakers and great people over there. So thank you so much.
Thank you, and I thank Mr. Abdul Basit Ali for his nice message on chat. Appreciated of your feedback. شكرا جزيلا. رامي شكرا جزيلا لك على كل شيء.
العفو يعطيك الف عافيه ما قصرت. شكرا جزيلا لك. Thank you very much everyone and let's carry on.
Thank you everyone. Thanks. شكرا لكم جميعا. شكرا.
السلام عليكم.